great to be in Istanbul. This is actually my first time. My name's Igor Telyatnikov. I'm the co-founder and CEO of AlphaPoint. And today I'm going to be talking about successful business models for institutions in the digital asset space. So first, a little bit of background on AlphaPoint for those of you that don't know us. So we've actually been quietly building infrastructure and powering exchanges, brokerages, and wallets in the digital asset space for over 12 years. Our team's background was building matching engines and technology for large financial institutions on Wall Street and integrating with all the major exchanges. And we've powered the largest exchange in Canada, the largest crypto exchange in Thailand, largest bank in various countries like Colombia, Thailand, and throughout Europe as well. So now I'm going to talk just about the business models. First, I'll talk about where we are in the adoption stream. The main point is that adoption is accelerating. We've seen that we've been on track for adoption in the cryptocurrency space in line with the internet, which many people have talked about. But the numbers that I find interesting is that we're still under 10% of users have ever experienced or transacted with cryptocurrency or digital assets. So as of today, the estimate is a little over 650 million users have ever traded or transacted with cryptocurrencies. That's up over 200 million from just 3 years ago. And it represents 8.2% of the global population, up about double from just 3 years ago. We think we're going to hit over 1 billion users in the ecosystem well before 2030, and then the next billion to come shortly after. So where is the next billion users going to come from? In our opinion, institutions are going to be the main onboarding vehicle. Those that have existing users that have not traded cryptocurrencies, and to be able to do that, regulation is starting to pave the way. We've seen a lot of regulation in the region as well as globally. Abu Dhabi ADGM, we have customers that are under that license, as well as VARA. MiCA is now in full effect. We're powering many with that license. And what it's really doing is helping institutions that were more conservative actually jump in, because they were waiting for regulations to not take a risk with a gray zone of can they offer these assets and trading or not. And another key takeaway for institutions is that participants beyond just growing the market, participants that are in the market, based on a survey that was done by EY, Ernst & Young recently, of market participants, over 50% said they would switch their provider of where they trade to their existing financial institutions where they bank or where their brokerage is. So this is both a huge opportunity for institutions to get involved to take some customers back to grow their business, but it's also an opportunity for existing platforms to partner with large financial institutions to be that conduit, because they have more experience in the space than the institutions may. And then the other trend that we're seeing, and a few panels have talked about, crypto exchanges and brokerages becoming super apps, powering payments, powering lending, powering borrowing. So beyond just trading and access to digital assets, now that many stock indices exist for Bitcoin ETFs or other major coins, and more are coming, trading is now moving towards other functionality. The ability to borrow against your collateral, Bitcoin-backed loans, the ability to lend out your assets and earn an interest rate, and doing this both on centralized exchanges as well as decentralized finance. And these are crypto firms like Coinbase and Kraken and others that are starting to offer tokenized stock trading and other financial services that traditional financial institutions now offer. So there's a big demand for both of these to really converge. So next I'll talk about the business models that are happening. So I'll actually dig into how much money is being made from a top line revenue perspective and drill into a few different business models in the space. So this is no longer a nascent industry. This is no longer an industry growing up. This is now, we estimate, over $100 billion worth of revenue is being made in the digital asset and crypto space annually. It's no longer peanuts. This is a snapshot of some US firms based on publicly available data from Q1 financials. So this is, you can go and find and back this data up, but Coinbase is on track to have over $8 billion worth of revenue this year. They had $2 billion in the last 2 quarters. We have PayPal, Robinhood, Circle, Cash App. So these are a few different business models, exchanges, brokerages, and then some neobanks or fintechs. And the total revenue just from these 5 alone, they're on track to have over $20 billion worth of revenue just with 5 firms. And then in EMEA, this is just a snapshot of firms that are generating tens or hundreds of millions of dollars annually as well. And these are based on estimates for 2024 numbers. So now what we'll do is we'll actually dive into the business models of a couple. I'll show you some S1 reports and how those break down and how companies are making money in this space. So I'll start here with Coinbase's revenue numbers for the last 4 quarters or 5 quarters here. So it's a little hard to read, but one of the, $2 billion is the top line revenue for Q1 2025. It was $2.2 billion in the 4th quarter of last year. And I think one of the most interesting points is that the majority of revenue for Coinbase used to be trading. If you look at Q1 of 2024, out of 1.6 billion, over $1 billion of that was in just trading, and that was a bigger percentage years ago as well. Now it represents only about 55%, 57% of their overall revenue. So where is that other revenue coming from? It's coming from staking and yield assets. It's coming from stable coins. This other transactional line here is actually from Base. So they've been making $67 million a year from an L2 and transaction fees on Base and a couple other lines. So I'll go in and break down for an exchange what the typical revenue models are. So the main one that exchanges make is a trading fee. If you trade $1 million or you trade $1,000, the exchange will charge you anywhere from 10 to 150 basis points. 100 basis points is 1%. So if you have $10 million worth of volume, 50 basis points, that's $50,000 worth of revenue. So that's the most general, standard model for exchanges. But some of the new revenue lines are coming from things like yield and staking. So instead of taking a small, 1% or less, exchanges and other platforms that are offering staking and yield services take a much bigger percentage of the staking revenue. Anywhere from 5 to 30%, even 40%, 50% we've seen of the yield that's generated is kept by the platform. And sometimes the platforms can stake assets and not share anything with the end user. So if you have $10 million staked, generating 10% a year, and you take 30% of that, of the $1 million that's generated, that's $300,000 that the platform keeps, $700,000 that's paid out and distributed to users. Custody fees, many platforms have, Coinbase Custody and other custody providers like a BitGo or a Fireblocks, they'll charge custody fees and potentially transaction fees on withdrawals. So you can earn, on average, 30 basis points per year for assets that you're custodying. So if a platform has $100 million on deposit and they're charging 30 basis points or 0.3%, that's $300,000 a year in fees that they're generating. And then lastly, the category that's new and upcoming, it's grown significantly in the last 12 months, is layer 2 blockchains, and where there's a private label blockchain. In Coinbase's case, it's Base, that's built on top of Optimism, but there are others where they have sequencer fees or transaction fees effectively for transactions that are being powered on the blockchain. And just in the last 2 quarters, they've generated over $65 million per quarter just in that line item alone. So moving on, there's other business models. And I'll just really point out the differences between these. So when you talk about a brokerage and OTC desk, the main difference between a brokerage and an exchange is that the exchange lets peer-to-peer trading, so 2 users on the system trade against each other. Brokerage is typically the counterparty. So they're the ones that's selling you the Bitcoin or the stable coin. They take the other side and they have to go hedge. one of the main areas of revenue, which is generating a fee, is a price spread. So if I can buy Bitcoin for $105,000, the platform may be able to source that same Bitcoin for $104,000, having a $1,000 worth of spread on that one Bitcoin transaction. So on average, these spreads can be quite high, anywhere from 50 to 200 basis points. So $10 million worth of volume at 100 basis points is $100,000 worth of revenue. The trading fee is the same as the other example with exchange, and then there can be premium pricing or premium spreads generated on less liquid assets. So for your highest volume pairs, you may be charging 10 to 50 basis points. On less liquid assets, you may be charging up to a few hundred basis points, up to 5% we've seen. So another model that we're seeing grow is more of a payments model. So wallets and payments. The examples of larger firms I'm mentioning is more of a PayPal, somebody that has a merchant processing business, and they're also offering swaps now to trade cryptocurrencies, and they're integrating this functionality. So the merchant processing fee, this is to help merchants, any grocery store. We actually helped the government of El Salvador set up Chivo, which is the largest financial application in that country. All of the grocery stores accept dollars and Bitcoin payments through Chivo. So in that model, you can charge anywhere from 10 to 300 basis points to accept the payment, as well as a conversion. Whereas credit card fees, merchants are used to paying anywhere from 1 to 7% in developing countries. This can be a less expensive way for the merchants to accept payments. There's also debit and credit cards. So the platform can actually issue a card that's privately branded. When merchants pay the interchange fees, they pay 2 to 5%. That's what the merchant loses by accepting the payment. But that credit card, when it's the issuers, the exchanges, they're actually earning revenue back from every swipe. And that's anywhere from 50 to 200 basis points, what they negotiate with the credit card processor. And then the swap fees, because these platforms are normally much more focused on payments and those types of transactions, there's a lot less price sensitivity to swap from one currency to another. So anywhere from 0.5% to 7% can be charged there. So next is a neobank example. This is very similar to the previous one. Revolut is an example. But one thing I wanted to highlight is, a traditional payment platform that's now offering crypto, 32% of their profit is coming from crypto transactions, over $3 billion in total. And they're charging 1.5% for every swap or transaction, plus they're charging spreads. So the price that they pay may not be as competitive as a different location. So you have the spread revenue, you have trading transactions, and the other thing that neobanks are doing is they lend money. They lend money to individuals, they lend money to small businesses, and then there are fees that can be generated on the lending, anywhere from 50 basis points, 0.5%, all the way to 10% per annum. So if you have a $10 million loan at 2%, that's generating $200,000 worth of revenue for the neobank. Next is RWAs. So RWAs, real-world asset or tokenization platforms. These are really coming back around in this cycle. I'll just focus on the unique revenue lines for these. So for tokenization platforms, there's a lot less trading happening, and it's really much more around project finance. Somebody's raising money, they're selling a token, maybe they're raising money to build a building, maybe they have a building and they're basically trying to raise some capital for other projects, but they're going to share the income stream from the building. So listing and onboarding fees can be charged, including tokenization. That's typically it can be a flat fee or a percentage, but on average 5%, 1 to 5% is charged for the listing fee. There's with the primary transaction fee as well combined. And there's also a revenue stream of paying out dividends. So when you have an income stream and you're paying out to token holders, the RWA platform is typically charging 1% on those distributions. So if $1 million is distributed, you can generate revenue from that as well. And then secondary trading. So in summary, there's a lot of different revenue streams. This is just a highlight of some of the biggest ones. So different platforms, exchanges versus brokerages, neobanks, et cetera. There's different lines that you can charge fees, and the business models are unique, but there's also a lot of similarity between them as well. So I'll leave you with what I started with. Adoption is accelerating. There's a lot more movement in the space, and there's a lot of demand that large financial institutions are getting for offering these services. The opportunity is massive. It continues to grow, and now is a great time to get in. So thank you very much, and enjoy the rest of the conference.